Hi, this is Matt Lockridge from Westwood with your fourth quarter 2018 equity update. After generating the best quarterly return in nearly 5 years during the third quarter, the S&P promptly fell 14% in the fourth quarter, the worst quarterly return in 7 years. The underperformance was broad-based, with 10 out of 11 sectors down during the period. And the large cap S&P 500 was not alone in showing negative performance. Frankly, all risk asset classes declined during the period. These negative returns and the dramatic increase in volatility were driven by several factors. First, the continued geopolitical uncertainty, such as the trade tensions with China and the potential for a hard Brexit later this year. Second, investors continue to grapple with the pace of interest rate increases and the balance sheet normalization from the Federal Reserve. Chairman Powell surprised investors early in the quarter, as some of his comments seemed to indicate the future path of interest rate increases was steeper and longer than many anticipated. Finally, economic growth did moderate during the period from the fast pace we saw earlier in 2018. As we look to the coming year, we still believe the U.S. is on solid economic footing. Growth will moderate from 2018's above trend pace, but absolute growth will remain positive and supportive for equities in our view. The boost from fiscal stimulus will moderate, partially offset by the recent decline in commodities and the associated ease on inputs. And the strong employment picture will continue to be a plus. From a corporate earnings standpoint, we estimate growth will slow from 20% plus seen in 2018 to mid-single digit type growth in 2019. We believe the market has recalibrated for this slower earnings growth with the fourth quarter decline. With sentiment much less bullish today than when we started in 2018, there is a better potential for upside surprises when company reports earnings. One data point we are watching is, though it's early, 80% of companies are beating expectations when they report their fourth quarter results. We'll continue to watch this trend as earnings season progresses. We continue to monitor the yield curve closely. The 10-2 Treasury spread stands at 17 basis points today, up modestly from the December low. A flattening and eventually inverted curve has preceded each recession over the last 40 years. And while this is a worrisome statistic, it's important to remember that the timing of the recession following an inversion varies with a wide band, from 10 months all the way to 3 years. Secondly, we're watching for signs of a resolution on trade tensions between the U.S. and China. If the 25% tariffs go into effect on March 2nd, this would more than offset the incremental stimulus from taxes and fiscal spending. So any positive movement on trade would be received well by the market. Given the current U.S. equity market backdrop, one sector that looks particularly attractive to us is healthcare. In addition to the demographic tailwinds helping many in the sector over the coming years, a number of industry leaders have undergone significant consolidation to position them well for the future. These vertically integrated players, often controlling various parts of the healthcare chain, including insurance, benefit management, distribution, pharmacy, and point of care, are the companies we expect to lead the sector in the years ahead. Given the recent market decline, the valuations look compelling for these fundamentally sound businesses with increasing strategic advantages. Thank you for watching this U.S. equity update and for your interest in Westwood.